Deductions are good, credits are better. Credits are, guys, dollar for dollar reductions in your tax liability. So you calculate your tax liability. If you are lucky enough to have a credit, it just simply reduces the taxes you owe by that much. Whereas deductions are only as good as your marginal rate. So here we have a taxpayer who's got a $5,000 deduction. That reduces his taxable income, and it does reduce his tax liability. But here, that same taxpayer who's got a $5,000 credit instead of a deduction, I mean, he ends off better by about $3,750. And really, again, this is because that deduction helps you out, guys. But if you look at the difference between this and this, it's $1,250, okay? And that's because if you take that $5,000 deduction times his marginal rate, well, that's your $1,250. That's why we say deductions are only as good as your marginal rate. So deductions are very much affected by whether you're a low earning taxpayer, a high earning taxpayer. Okay, credits help everyone equally. Deductions do not. Okay, if you're a high earning taxpayer, your deductions help you out a little more. If you're a lower earning taxpayer, they're going to help you out a little bit less. So tax credits generally are more favorable. Now, we have several different types of tax credits. The book kind of categorizes them into refundable, non-refundable, and business credits, okay? Refundable credits, guys, as the name implies, if you have a tax liability of $3,500 and you have a refundable credit of $5,000, the IRS will cut you a check back for $1,500, okay? That credit will actually entitle you to money back. Most of the credits, guys, though, are going to be non-refundable credits, okay? The best they can do for you is drive your tax liability down to zero, but not any further than that. So, again, if you had that same tax liability of $3,500 with a non-refundable credit of $5,000, okay, it could bring your tax liability to nothing, and the other $1,500, guys, it just kind of evaporates, it goes away. You can't ever make use of it again. Now, in the case of business credits, however, business credits work the same way as the non-refundable credits in that they can only bring you down to zero, no further, okay? But the business credits, guys, they don't get lost. They're not gone. You can look back to last year's tax return and possibly use it then, or you can pull it forward for 20 years and hopefully use it and get the advantage of it on a future tax return sometime in the next 20 years. Okay, so business credits are a little bit better than the non-refundables, but they work generally in the same sort of way. And we'll talk a little bit more about these as we sort of move through. We're going to start with the first non-refundable credit, guys. It's the child tax credit. Look, the book mentions that it's partially refundable, guys, but for our purposes, we're just going to treat it as a non-refundable credit. Don't worry about the fine print where it starts talking about that 40% of it is in fact refundable. Don't worry about that, okay? The child tax, guys, the credit here is really for taxpayers who provide homes for certain qualifying children, and yes, it's the same qualifying children from our Chapter 4 rules. You know, our relationship test, our age test, our residency test, our support test. I'm not going to test that again, guys. We've been there, done that. So I will make it clear. The big thing here, guys, is to take note, okay? It says a qualifying child under 17. 17 is not under 17. 16 is under 17. So if it helps you to write 16 and under in your book instead of 17, then do that, okay? It has to be under 17 years old. And they start off by saying that for each qualifying child under age 17, you're entitled to a $1,000 child tax credit. But as the IRS, or I should say Congress does so often, okay guys, they give with one hand and they take away with the other hand. So this is, of course, subject to a phase-out based on the taxpayer's AGI. And this is a bit of a unique phase-out. It's not our standard percentage phase-out here, okay? This phase-out says that for every $1,000 the taxpayer's AGI exceeds the threshold, they pull back $50 from that initial $1,000 that they offer you, okay? And we'll do a quick example here.
Can you say that one more time?
Yes, for every $1,000 that a taxpayer's AGI exceeds the threshold that they give us, they take back $50. Okay, we're going to look at problem number 72, and we'll look at part A quickly. 72 starts by saying Trey claims a dependency exemption for both of his daughters, age 14 and 17, at year end. Trey files a joint return with his wife. What amount of child credit will Trey be able to claim for his daughters under each of the following alternative situations? So he has two daughters, 14 and 17, and he has an AGI of $100,000. And guys, I put up here the threshold. He's married filing joint, and the married filing joint threshold for this tax credit is $110,000. So what would he be entitled to? $1,000, right? Okay, you have to discount the 17-year-old because she is not under 17, so only the 14-year-old is qualifying child. And his AGI is lower than the threshold, so we're all good there. He gets the $1,000 for the 14-year-old, but not for the 17-year-old. And he's not subject to a phase out. Let's skip to Part C. Part C says his AGI is $122,100, and his daughters are 10 and 12, okay? So his daughters, guys, now are both qualifying. That's good. So he potentially has $2,000 of tax, but he's over the threshold, okay? So, of course, now we have to phase him out, because once you go over that threshold, they're going to start to take back. And these rules say that by the amount you exceed the threshold, which is $12,100, okay? You first divide it down by $1,000. This is just a given rule, which gives you to 12.1. Okay, guys, this is like our exemption rule, like where I said you're gonna want to round down to 12. Don't do it. Go up to 13. Okay, you have to go up. Go against your nature. Go to 13. Okay? You take that number times 50. Again, this is given. They say for every $1,000 you go over, multiply it by 50, which is $650. So this is his phase out. Don't stop here. Okay? Don't stop here. We said he's eligible for starting $2,000. His phase out is $650. So his credit, guys, here is going to be $1,350. Okay? I will give you guys the thresholds on this. Okay, guys, the important thing is remembering how old is the child. They have to be under 17. And this is, again, this is a little bit of a quirky sort of phase out. Round up, don't round down. Okay, it's pretty straightforward. So I think this one's, you guys can do this. Okay, that's the hardest part right there. If you remember to round up, you should be good. Okay. The next credit, guys, is the child and dependent care credit. Similar names, so be careful. Okay, the first one was the child tax credit, and that's for taxpayers providing children with homes. This is the child and dependent care credit. And this helps taxpayers who have to pay for daycare, babysitting for certain dependents. It's provided to give them some relief, okay? Now the rules here, guys, say that to qualify, it has to be a qualifying child or qualifying relative, okay? A little more broad, qualifying child or qualifying relative under 13, okay? Under 13 this time. Or alternatively, guys, it could be a qualifying child or qualifying relative if they are mentally or physically incapable of taking care of themselves. So it could be someone under 13, qualifying child, qualifying relative under 13, or qualifying child, qualifying relative who can't take care of themselves. And we have to look at 3 possible alternatives for the starting point of this credit, okay? You have to take the lesser of the actual amount you pay for babysitting, daycare, what have you, okay? Or there's a flat $3,000 rate for one qualifying person, or $6,000 if it's multiple qualifying persons, okay? It's just an IRS given number. That's your second option. Or you have to use the earned income of the lowest earning participant, spouse, I should say. So if you're married filing joint, you have to look to the earned income of the lowest person. Guys, be careful, the term earned income, okay? Don't use AGI. You're looking for earned income. And we know earned income is salaries, wages, tips, commissions, bonuses, things you labor for. Self-employment earnings, okay? These are forms of earned income. If you have a couple married filing joint and one of the spouses is a stay-at-home mom, stay-at-home dad, okay, guys, and they earn nothing, you will not qualify for this credit because you have to use their earned income, which is 0, okay? And therefore, you'll have no starting point for the credit. If you're married, filing separate, you do not get this credit, okay?
What's this credit called?
This is the Child and Dependent Care Credit.
So if you're married filing separately, you don't get it.
No credit. It says, the rules here say if you're married, you have to file jointly. Okay. Another catch here, guys, is that the care cannot be provided by one of the taxpayer's dependents. So if you're paying your teenage daughter to watch your children while you go to work, you're not going to qualify. If grandma lives with you and she's also your dependent and she's watching the kids and you're paying her, okay, that's not going to qualify you for this credit. You can't be paying the money to another dependent and then cause yourself to qualify.
So what actually has to do with nursing home?
You could have a babysitter come in, you could pay your next door neighbor, they just can't be your dependent. So you don't actually have to take the child out of the home. Okay? So guys, you take the lesser of those 3 numbers we just talked about, okay? And then the IRS gives us a chart, which I will give you, okay? And then you look to the AGI on this chart and figure out what your credit is. And it ranges anywhere from 35 to 20% of the lesser of those 3 expenses. So we will look at number 73. Here we have Julie. She paid a daycare center to watch her 2-year-old son while she worked as a computer programmer for a local startup. What amount of child and dependent care credit can Julie claim in each of the following alternative scenarios? And we're just going to skip to E, guys. Okay. E says Julie paid $4,000 to the daycare center. Her AGI is $14,000, $2,000 which is salary, and $12,000 which is unearned income. And originally in the heart of the problem, they told us that it's her 2-year-old son. Okay, so we know he's qualifying. He's her qualifying child under the age of 13. But that is something you have to look for. Is this her qualifying child or relative? And then they give us the other facts here. So guys, you're going to need the chart on the top of page 827. Okay. And here, we wrote it out. She's got a 2-year-old son. She's got $14,000 AGI. $2,000 is earned, guys, and this is what we need, right? $2,000 is unearned, and then she paid $4,000. So, guys, you're looking at the lesser of the amount she actually paid to the daycare center, let's call it, okay? Or the IRS says that if you have only one qualifying child, it's $3,000. Do you have a question, Justin? No. Okay. Or you look to the taxpayer's earned income. If they're married filing joint, the lowest earning taxpayer. She's single here, so we have to use her earned income now of $2,000. Okay, that is the lowest of the 3. We have to use her earned income.
If she had 2 children, it'd be 6,000.
This would be 6,000 if she had 2 children, but we would still pick this chart because it's the lowest of the 3. But yes, it would change to 6. So our starting point for the credit is $2,000, but then we need the chart, okay? And the chart, guys, is based on AGI, okay, not earned income. So for the lesser of, we're using earned income. When you go to the chart, you are using AGI. Her AGI is $14,000, okay? So she's entitled to 35% of this number. So her credit is $700. Okay? Guys, again, just be careful. You got ages in here. You got earned income for one portion of the calculation. You got AGI when you're going to the chart, okay? Just be careful.
So she's entitled to 35% of the tax credit?
35% of the lesser of these 3. So these were our lesser of. So first you have to figure out, is it a qualifying person? okay? Then you go through the exercise of saying what is the lesser of the actual cost of the daycare, the 3,000 or 6,000, or the earned income of the lowest earning taxpayer. Okay, you pick that number, that's the starting point for your credit. Then you go to the chart, look up the AGI, that gives you an appropriate percentage. You multiply that times the percentage, that is her credit. Okay? Okay, guys, now there's two education credits here, the AOC credit and the LLC credit, the American Opportunity Credit and the Lifetime Learning Credits. Guys, if you think back to the early part of Chapter 6, you were allowed to take potentially up to a $4,000 deduction for qualified education expenses. But for those expenses, it really mattered who pays those expenses, okay? You could have parents who claim their child's exemption, but if the child was paying for their own education, nobody was entitled to that 4 AGI deduction. That's one of the rules there, okay? Here, however, it doesn't matter who pays the expenses. So as long as the parents are claiming the child is exemption, then they will qualify for this credit. It doesn't matter if the child or a third party pays for their own tuition. So that's a big help with this credit. The parents are entitled to this credit as long as they're claiming the child. Plus, guys, keep in mind, we also just said it's generally better to take a credit over a deduction anyway. So given the choice between the two, they're probably going to want this anyway, okay? Pointing out again, married filing separate, guys, can't take this credit, okay? Can't take this credit. We'll talk about each separately, and then these kind of come hand in hand, so we'll work the problem with both of them together. The AOC credit, guys, applies only for your first 4 years of post-secondary education. So the first 4 years out of high school. So this is really generally going to be, guys, for your bachelor's degree, your associate's degree. And it requires a more formal education, a degree program under the rules, okay? So again, really your bachelor's, your associate's is what you can use this for. Okay, you can't use it for law school, you can't use it for grad school. Okay. The credit itself, guys, now be careful here. The credit says that it is 100% of the first $2,000 of expenses, okay? And it's 25% of the next $2,000. Now do the math on that, that's $2,500. Don't fall into the trap, okay? I could say, you know, I spent $3,000 in tuition, and you're going to be saying, oh, well, the credit's $2,500, so it's all good. But it's not. It's the first 100%, the first 100% of the first 2,000, so that's good, 2,000. But it's 25% of the next 2,000. Well, if I spent 3,000, I could take the first two, okay? I have 1,000 left over times 25%. is $250. Okay, so my credit, in fact, would only be $2,250. I couldn't just take the full $2,500. So be careful. A lot of people have a habit of just remembering $2,500 and using $2,500. Don't look at the numbers. Okay.
I have a question. With this credit, is it this first 4 years of post-secondary education? Does that have to be consecutive, or it's just basically saying it's if you're going to college? Like if you stop and go and you take the credit here and there?
It doesn't say consecutive. It just, I think it's just only good for really, like I said, your associate's, bachelor's, if you get extra education. I also don't think it matters if you don't go to college right away and then maybe you go 5 years after high school. As long as it's for the first 4 years of education right after, then you should be fine.
Professor, what if in order to get a bachelor's, you don't get a bachelor's in 4, but you get it 4.5 or 5? It's
Only for 4 years.
Only for 4 years.
Only for 4 years. This credit is only good for 4 years. Yep. Okay, guys, also this credit, the $2,500, is good for as many eligible people. You have 5 children going for their bachelor's degree, okay, and you have qualifying expenses for all of them. You can take 5 times $2,500, okay? So this is good for as many people as you have going to school who qualify. Guys, be careful here, okay? This AOC credit is good for tuition, fees. Guys, fees are like they charge you here for like the library, for like computer rooms, those are fees, okay? And materials. Materials are the books you buy. You're required to buy a computer. You're in a science lab. You need lab equipment, okay? Materials. No room and board. No room and board, okay? Typically, the IRS will never fund room and board, very few exceptions. Okay? The rules say that it has to be paid during the tax year you're taking the classes, or the classes can start within the first 3 months of the next year. So it's November, tuition bills probably are starting to come out for next spring, okay? If I pay for, let's say, classes I'm taking starting in January, it's okay. I can still take the deduction now as long as I pay for it now, okay? So they offer you this $2,500, guys, and again, they do what they do best. They take it away. There is a percentage phase out for this credit, okay? And I will give you the phase outs. The LLC, limited lifetime learning credits, how I call it, limited liability. Guys, this one is for tuition and fees only. No materials, no room and board. This one is a little more broad, guys. It applies to generally any course of instruction. So it could be, you know, me brushing up on my job skills. It can be here for grad school, law school. It can be for those 5th, 6th, 7th years, your PhD, what have you, okay? A little more open here. The credit itself, guys, is for 20% of the first $10,000 of qualifying expenses. 20% of the first $10,000. So it's a potential $2,000 credit. This one is limited, 1 per tax return, right? 1 per tax return.
So it
And
doesn't matter what the education is for.
this one really kind of doesn't, Jared. It's pretty open. Okay? There's a phase out. And it's a different phase out than the AOC phase out. It's more tight here, okay? This one becomes much more restrictive, much faster. Guys, you can't take both credits for the same person. You have one student going to school, you can't take the AOC and the LLC, okay? Just know you can't double dip, you can't do both. So you can't kind of say, I have one kid and I spent $20,000, so I'll use the first 10 for the LLC, and I'll use the remaining, 10 for the AOC. Can't do that, okay? So one or the other. And generally, guys, you're gonna wanna take the AOC when you can. A, it's bigger, it's $2,500 versus $2,000. B, it's only available for 4 years, right? The LLC is always available. And if you have multiple children, say, then you can have multiple AOC credits, whereas you only get $2,000 for the LLC. So you're generally going to try for the AOC if you can. Which brings us to question 75. Yeah.
When you say you can't take the AOC and LLC, is that just for the same person or?
For the same person.
Alright, so
You can have one child taking one and one child taking the other, yes. Just for the same person. Okay, guys, 75. We have Maureen, she is single. She paid $2,800 of qualified tuition and related expenses for each of her twin daughters, Sherry and Mary, to attend State University as her freshmen. Sherry and Mary qualify as her dependents. She also paid $1,900 for her son Ryan's tuition, related expenses to attend his junior year at State. Finally, she paid $1,200 for herself to attend seminars at a community college to help improve her job skills. What is the maximum education credit she can claim? Okay. So on the first part, they tell us her AGI is $45,000. All right, let's just focus on that. So $45,000. Okay, guys, she's got 4 different sets of expenses. She's got herself that she spent $1,200 on, and I'm calling these work-related. That's my shorthand. And then she's got her 3 children, the twins, who are freshmen. I'm just putting BS for bachelor's degrees. and her son, who's a junior, I also have as a bachelor's degree, okay? So they are potentially qualifying for this AOC credit because they fall right in the wheelhouse for that. Laureen, right guys, she can't take the LLC because this isn't her first 4 years of school immediately after high school. So, and $45,000 guys, these are the phase outs I put for single for the AOC and the LLC. It's 80 to 90 on the AOC and 55 to 65 on the LLC. So right off the bat, she's not gonna fall prey to either of the phase outs, so we don't have to worry about that for at least this first part. So first guys, we have, I'll put Sherry and Mary, we'll work them together. And they have $2,800 in expenses. Again, guys, don't just sit there and say, oh, $2,800, therefore I'll just take $2,500, it fits safely. It doesn't, okay? It's 100% of the first $2,000 and 25% of the next potentially $2,000. Well, they have $800, so that's $200 more. So she can claim $2,200 for each of the girls, okay? Sherry and Mary. I'll put another $2,200 there. Okay, so we got that one and we got that one. We also have Ryan. Okay, his is only $1,900, so we could take all of that. And then we have Lorene, okay? She's not gonna qualify for the AOC. Again, guys, she's not in her first 4 years of school, okay? So she's gotta fall under the LLC. So these guys are the AOC. And that works out to $6,300. Maureen, on the other hand, is the LLC. She's got $1,200 of expenses, guys. It's good up to the first $10,000. So we could take all $1,200 of hers. So she's gonna be the LLC, and that's how she would have to claim them on her return, okay? Oop, what did I do? Sorry, 20%, what am I doing? I lost my mind. $240, sorry. Okay. Guys, Part B asks what happens when her AGI is $95,000. Zero, right? She makes too much money. She's way over the threshold, not way, but she's over the threshold, so she can't claim any of these if she makes $95,000. Okay? Let's look at Part C. They changed the facts a little bit. Maureen's AGI is $45,000, and she paid $12,000, not $1,900 for Brian, to attend grad school, his 5th year, not his junior year, okay? So again, guys, you can't use the AOC for anything past those first 4 years. So he has to come out of the AOC now, and he's gonna fall into the LLC with Lorene. Okay, so Sherry and Mary, guys, are gonna be the same. So we're just gonna keep them. But now we have Ryan and Lorene. She spent $12,000 for him. She had $1,200 for herself, so that's $13,200. Okay, times 20% is $2,640. Okay, but we can't, right? We can't. We're limited to $2,000. So don't do that. Well, at $2,000. Okay. Anyone else see anything else wrong?
Only one per tax?
Well, one per tax
You're
return.
gonna add both of them together?
I'm gonna add both of them together. I'm gonna figure out their total expenses. Then I'm gonna take the 20%. That brought me over $2,000, which is why I discount it down to $2,000 because that's my max LLC credit. Anything else?
And you have to phase it out?
I have to phase it out. Okay. She makes $45,000 in this scenario. What the heck? Sorry, wait a minute. That's not right. She's subject to the phase out. I know she is. Or did I subject her to the phase out in my own version of this? Oh, no, I had my own version, sorry, it's not the book version. What I wanted to tell you is, look guys, if she made $60,000, okay? She made $60,000, you're gonna phase out this number, okay? If she made 60, she falls halfway into the range, so her phase out would be 50%. So we would cut this in half, okay? You would work your normal percentage phase out, but I wanted to point out, don't try to do, 12,000 times 20%, come up with a number for him, then do a number for her, okay? Add the expenses together, then take your 20%, okay? If it's over 2,000, mark it down to 2,000. Then check for the phase out. If it needs to be phased out, you phase out this $2,000, okay? Don't try and phase out a higher number.
Professor, wouldn't you just do, because the maximum is 10,000, so it's more than 10,000, wouldn't you do 20% 10,000?
You could do that. I'm a cautious person. I always work through the steps so that way I don't miss anything. You could, but I wouldn't tell you to do that as a general behavior because I think in the long run that catches up with you because like I was saying here, you might want to say to yourself, oh, she spent $3,000 on tuition, the credit's $2,500, so I'll take $2,500, but you can't, right? So I don't do those things, and I wouldn't recommend them. It will work here.
Yeah, because you said you're only allowed one, so I'm like, well, he
You
has
are-
the higher bill.
And I know what you're saying, but again, I wouldn't recommend it because I think sometimes you start taking shortcuts like that, you step on your own foot eventually.
Okay.
Guys, are you good with this? Okay, it's the little details again here, guys. The AOC has different requirements, okay? The first 4 years, tuition, fees, materials, no room and board. LLC, the credit is different, 20% first $10,000. The phase out is lower, okay? Tuition, fees only.
So because her AGI is within the range, then all you do is drop down to 2,000.
Yes, here they say the book says her AGI is $45,000. So she's below both of those, so she's entitled to whatever she calculates. If we made her AGI 60, she wouldn't be subject to the AOC phase out, so you wouldn't have to touch these, okay? But she would be subject to the phase out on the LLC, and you would have to phase out this number. And what I was trying to point out is go through this process, then do your phase out here. Okay, don't start phasing out numbers before you end up here. Get to your $2,000 or whatever lower number it may be, then phase it out. Okay?
The phase out is 50%?
If I said her AGI was $60,000, yes, the phase out would be 50%, because right, $60,000 AGI minus the low end of your range is 55, so that'd be $5,000. Over the spread of the range, which here is $10,000, so 5,000 over 10,000 would be 50%. That would be her phase out. So this is our standard sort of percentage phase out that you guys are used to by now. Okay. Any other questions?
Could you explain that last part again?
The phase out. If I said her AGI was 60, okay, she would be subject to the LLC phase out. These both have different ranges here. So you would take her AGI, that's always your starting point, minus the bottom edge of the phase out range. So subtract off the 55,000, that gives you 5,000, okay? Then you divide that 5,000 by the spread of the range, okay? So the spread of the range is from 55 to 65, so that's 10,000, that's your 50%, okay? Okay guys, so those are the popular non-refundable credits. The popular refundable credit that a lot of people claim will be the earned income credit. Okay, that's the refundable credit we're gonna look at. Guys, this credit exists because if you go to way back when, maybe the first or second class, we talked about flat taxes and regressive taxes and proportional taxes. Well, the FICA taxes that we just covered, okay, we covered Medicare, which is a flat tax generally because it's a 1.45% unlimited tax, okay, that's a flat tax. And our Social Security tax, guys, is actually considered a regressive tax because you get taxed on the first 6.2% up to $118,500, and then it stops. Okay, so it actually becomes regressive. It helps out the higher earning taxpayers because the more money they make, the effective rate of that tax actually drops. So these FICA taxes, guys, really hurt lower earning taxpayers more. They take a bigger bite out of their take-home pay than they do for higher earning taxpayers. So this credit is designed to alleviate some of this and encourage those lower earning taxpayers to go out and work rather than just saying, you know what, it's just not worth it because you take too much away in payroll taxes. So they're trying to give back a little bit with this earned income credit. That's the idea behind this tax. The rules for this one, guys, say you have to have two things. You have to be a qualifying taxpayer and you need earned income. That's the name of the credit, okay? Now, to be qualifying, you need to have at least one qualifying child, or you don't need to have any children, okay? But you must be at least 25 years old, so 25 or over, or under 65. 25 or older, but less than 65, and you can't be someone else's dependent, okay? Married filing separate, can't get this credit.
You said less than 65?
Less than 65. Yeah, if you hit 65, you're too old.
And if you're 25.
If you're exactly 25, no qualifying children, you can qualify, as long as you're not someone's dependent.
So if you're in that like age range, then you can't have qualifying.
You can. The rule says you can have one or more qualifying children, or you don't have to have a qualifying child, but you have to be at least 25, less than 65, and just not be someone else's dependent. So you don't have to have children to get this.
So if you do have a qualifying child, it doesn't matter what your age is?
Right, exactly. Okay, guys, so married filing separate don't qualify. And then there's another little quirky rule to throw in here that says if you have investment income, okay, investment income of more than $3,400, then you don't qualify. Can't have the credit. Okay, investment income, not something we've heard this term before. This is not necessarily the same as unearned income, okay, guys? Investment income, interest, dividends, cap gains, rentals, royalties, annuities, okay, investments, true investments.
What was the amount over?
3,400. Okay, guys, and then I'm gonna have you hopefully have a book because this chart is not at all intuitive, nor is tax, I guess. There is a chart on page 831 that I would highly encourage you to turn to, and I would also encourage you to work through some of these problems. We're not going to go through all of it, but I would encourage you to use this chart a bit because, like I said, it's not second nature, this chart. We are going to look at problem number 76. Okay, and we are going to look at part A first. So we have Amanda and Jackson Stewart. They have a daughter who is 1 year old. So we're going to assume that they're qualifying child, okay, and that they're married filing joint. They are full-time students. They are both 23 years old, okay, but that doesn't matter here, Samantha, right, because they have a qualifying child. Their only sources of income are gains from stock they held for 3 years before selling and wages from part-time jobs. What is their earned income credit in the following alternative scenarios if they file jointly? Part A says their AGI is $15,000, consisting of $5,000 of cap gains and $10,000 of wages. They don't qualify, right, guys? Those cap gains are just going to qualify them. They're more than $3,400. Okay, guys, again, this is investment income. Look at the terms, okay? Interest, dividends, cap gains, rents, royalties, annuities.
What if they had something left, left for them in their trust? Would they qualify? Like if they had a relative, like a parent passed away and they left it.
If it's a gift, I mean, a gift isn't a investment income, but if it's, they have a gift and the gift was growing money, then that technically is their interest and they would own that. So I guess if they could prove that it didn't come from the earnings from the gift, but it came from the principal, they might be able to avoid it. Okay, let's skip to Part D. Their AGI is $25,000, consisting of $5,000 of wages and $20,000 of lottery winnings, unearned income, okay? Guys, those lottery winnings, that's unearned income, those are not investment income, okay? Investment income is what we just talked about, so again, be careful of the terms. Those lottery winnings of $20,000 are not going to disqualify them. I don't even know where I put anything anymore. Okay, so we're working on Part B here. So they have AGI of $25,000, which is made up of $20,000 of lottery winnings, okay? Don't disqualify them, okay, that's okay. And $5,000 of earned income. Now we need our chart. So, they are married, filing joint, so we're gonna use the top portion of this chart. And they have one qualifying child, the problem told us, okay? So we're gonna scoot down to the second row where it says 1, okay? And the way this chart works, guys, is you need to first focus on your earned income, okay? We know they have $5,000 of earned income, okay? At a maximum, someone with one qualifying child could use up to $9,880 worth of earned income, okay? Times 34%, so their maximum starting credit would be $3,359, okay? But our taxpayer guys, they don't have $9,880 of earned income, so we're gonna use their smaller number, okay? That number in the book is the cap. So if our taxpayer here had $10,000 of earned income, okay, we have to stop at this $9,880 point. And the maximum starting point for our credit would be the 3,359, okay? But we're less, so of course we're gonna have to take a smaller number. So we're gonna use our $5,000 times that 34% credit. Okay, equals 1,700. That's the starting point, guys. Again, there's always a phase out. They give and then they take back. Okay? So you have to keep scrolling over. And the rule says that if you have AGI now, okay, AGI of more than 23,630, you have to phase it out, the excess out, by 15.98%. You're fully phased out if your AGI exceeds that 44,651. Well, our taxpayers have AGI of $25,000, okay? Minus the threshold that they give us, that 23,630 is 1,370. Then we have to use the phase out percentage that they give us in the book, which is 0.1598. And that works out to 218 and change. We'll make it 219. Guys, this is the phase out. Don't stop there. I know you're not going to. Okay? So we're going to go back to our initial credit that we calculated. Minus the 219. That gives us 1481. That is their earned income credit. Okay? That is their earned income credit. Guys, there's like 4 other parts to this column. There's practice exercise set up and connect. Work through it, because this chart in particular, some of the other charts you could figure out on the fly, not a big deal. This chart, you need to work through it a couple of times. Okay, it's just not second nature, this chart. Any questions?
So you need to give us this show then?
I will absolutely give you. I will give you all the charts. Any of the phase outs range, the chart I would give you. That other chart we just looked at on 2 pages prior, I would give you. Yeah. Okay. You guys have to know the formulas, but I will provide you the charts. Good, guys?
you have investment income under the 3,400, that's not included still, right?
Then you're still qualifying for the credit,
But that's not
and
included in
you would include it in your AGI. Yeah, they just once you hit $3,400, they just take the credit away altogether. As long as you stay under that amount, you could still qualify, and you would still include it in your AGI.
It's the taxpayer's responsibility to fill that out, right, to look for that credit?
Absolutely. Yeah. They always have people who can help you work on it, because it is complicated actually, but it's your responsibility.
So on the chart, the 9,880, that's the maximum earned income that qualifies for.
Yes, if you have more earned income than that, you have to stop at that point.
Okay.
So our taxpayer is saying our taxpayer here might have had $10,000 of earned income, but they couldn't take more. That's the maximum they're allowed.
Oh, so now we're taking 9,880 and go through the formula.
Then you would say times 34%, and they give you the cap right there, Henry. They say maximum credit for that person would be 3,359. So that would be your starting potential credit. You'd still then have to work your way through the phase out. Yep. Okay. And like here, if your earned income is less than that number, then you have to use your lower earned income figure. Okay. Okay, guys, that's the earned income. The book touches on business credits, guys. Look, I'm not overly interested in business credits. Why do they exist? I mean, they encourage companies to locate in certain areas. You know, there's enterprise zones, certain states try to attract certain types of businesses. They try to entice companies to hire certain classes of workers to keep emissions down. There's tons of business credits out there for various reasons. Again, guys, this is Congress's way of manipulating us into working and doing certain things by giving us these credits. And again, we like credits because they're dollar for dollar reductions of our tax liabilities. They're generally more beneficial than a deduction. We don't usually jump on a credit. We're usually pretty interested. Keep in mind, guys, with the business credits, okay, they can't drive your tax liability past zero, okay? But unlike non-refundable credits, you can carry them back one, you can carry them forward for 20. So whatever unused portion here, the $1,500 that you couldn't use this year, you could bring it back 1 year, maybe use it on last year's return. You could carry it forward for use on the next 20 years worth of tax returns, okay? Foreign taxes. Guys, this is considered a hybrid tax. This is considered a cross between a non-refundable and a business credit, okay? Non-refundable, again, to the extent it can't reduce you down below zero, okay? But similar to business credit because it doesn't disappear. The foreign credit, you can bring back 1, you can bring forward 10. So always gotta change the rules. They can't just stick with one rule.
Wait, say that again?
You can bring it back 1, you can carry it forward 10, the foreign credit. Okay, so it's non-refundable, you can't earn a refund from it, but you don't necessarily lose the benefit. You can carry it back to last year, you can carry it forward for up to 10 years going forward.
Professor?
Yes?
What do they mean by carrying back?
If you had a tax liability on last year's return, you could take that credit, you can amend last year's return, and then use up the unused portion this year. You could bring it back to last year's return and offset it against last year's tax liability and get your money back. Okay. Guys, so we've talked about this a few times now, and this will be the third and last time that we'll go through this. We've talked about the fact that if you are a citizen or a resident of this country, the United States, the federal government is entitled to tax your worldwide incomes. So we don't care what country you made the money in, we are entitled to tax it, okay, because of the rights and privileges we afford you as citizens. But of course, the country where you work or own property is also going to want their piece. So you are facing double taxation, okay? We have covered 3 ways, or 2 ways, we're now covering the 3rd way that a taxpayer may alleviate this double taxation. The first goes back to Chapter 5. We talked about the foreign earned income exclusion. We said if you earn money in a foreign country, okay, you could exclude up to $100,800 worth from your gross income determination, okay? So you can exclude up to $100,800 of gross income on your 1040 returns. That's one option, okay? Another option is when we were going through the below the line itemized deductions, guys, we said that you can deduct state, local, foreign income taxes paid, okay? That was another option. You could deduct income taxes you paid to a foreign jurisdiction as an itemized deduction. Now here, they say you can deduct income taxes you paid as a credit. I shouldn't say deduct. You can take income taxes you paid as a credit. Okay? So 3 options. You could deduct, or you could exclude income, you could deduct the foreign income taxes, or you could take the foreign income taxes as a credit. Now you may be saying, well, you just told us 12 times that, you know, credits are better than deductions, so of course, who's not gonna take the credit? Or who would take the $100,000 income exclusion? Look, guys, the fact is that if a foreign country's effective rate is higher than ours, the credit starts to get reduced, and it may be more beneficial in those cases to use the income exclusion or to use the itemized deductions. Obviously, I'm not holding anyone accountable for that, but I just want to point out that would be why you wouldn't necessarily jump all over the credit in this case. So just be aware of that. That's really it for foreign. Okay. Guys, there is an order in which you apply your credits to get maximum benefit, okay? The general rule says you start with your tax liability, then you use up your personal non-refundables first, okay? Because to the extent you can't use those, guys, they disappear, so you want to use those up first, because otherwise you lose the benefit, okay? Then, let's say you're self-employed and you're filling out your Schedule C, and maybe you have some business credits available, you use those next, okay? Those 2 credits, guys, again, they can't bring your tax liability past 0, okay? They can't bring you past 0. But if you have an unused business credit, you can potentially carry that back, carry it forward. Then you have your refundables, okay? You use your refundables last, and those, of course, will generate a check back to you if needed, okay? Now, guys, and pointed out in the book, they call them refundable credits. I don't know that I would label them that way personally, because I don't think they're really refundable credits. You know, your employer withholds. If they over withhold you during the year, you have more taxes withheld than you actually owe. You're always entitled to get your own money back. If you make estimated tax payments and it turns out you didn't need to, you're always entitled to get your own money back. Okay, we talked about there's scenarios where they might over withhold you with regards to Social Security, right? We showed that if you started a new job, the second employer might actually end up over withholding you because they don't know what the first employer withheld. You're always entitled to that money back, okay? Anytime you're over withheld, you pay estimated taxes and it turns out that, you know, that money, you didn't need to pay it, you always get that back. It's always, they put it under the refundable category, okay?
What does it say next to
Sorry, my handwriting's awful. What?
is that an IS next to the top 3?
This one includes withholdings, estimated taxes, and then over withholdings on Social Security and Medicare. They're not getting my notes that way. Guys, there is a problem for this. It's problem number 78. I'm not going to go through it, but I would encourage you guys to do so. Okay, guys, that is taxes, okay? Nice and simple, no problem. Got it? I didn't write the book, now I don't think that on me. Okay, guys. So now the question is what happens if I don't pay my taxes, okay? Of course, there are penalties, and that is the last part of this chapter. So guys, as the book tells you, we have what is called a pay-as-you-go system. What does this mean? It means, look guys, you can't just go out and go about your business all year long and buy and sell stuff and go to work and do all sorts of things and then just mail in a big fat tax check come April 15th, okay? We are required to pay taxes at a minimum of a quarterly basis on, April 15th, June 15th, September 15th, and January 15th. you have to pay taxes, presuming you're earning money, of course, guys, and you have a tax liability, by quarterly. You have to pay by these dates each quarter. Now, for most of us, guys, this isn't a problem, okay? For most of us, we don't really think about this too much because the fact is you're probably working for an employer and they are required to withhold, okay? And presuming that they are withholding enough, then it's not a big deal, okay? If you're self-employed, however, just like your FICA taxes where we said you have to calculate and pay them, well, you have to do the same thing for your income taxes. You would have to sit down quarterly and figure out what your earnings are and mail a check off, okay, on April 15th, June 15th, September 15th, January 15th. You might also have situations, guys, where yes, you're working for an employer and he's withholding enough taxes to cover your wages, but maybe you like to do a lot of trading at night on the weekends, okay? Maybe you have a nice little income stream coming from these sort of side things you have going on. Well, you better be sure that you're mailing off estimated payments to cover that stream of revenue. Otherwise, you're gonna come up short at the end of the year and you may be subject to these penalties, okay? The idea is you have to pay quarterly for whatever you're earning each quarter. If you don't, then you may be subject to this underpayment penalty, okay? I wanna stress, guys, the underpayment penalty applies for the taxes that you are not paying during the year, okay? The clock stops ticking on these taxes on January 15th, that last possible payment date, okay? Underpayment penalty applies to the taxes you need to be paying during the taxable year. With me so far? Good. Okay. If you have a predictable stream of income, which most people do, you know, you're earning a salary and you know, maybe you have some nominal investments. It's relatively easy to sit down and figure out ahead of time what's my tax liability going to be for the year, and therefore what should I have my employer withhold. You get a say in that when you fill out a W-4. Now guys, there's a lot of people out there who don't know what they're making from day to day, month to month, okay? You might have people who make a steady salary, but really they're dependent on a big bonus come December, okay? And they don't know what that bonus is going to be. Or even worse, you might have salespeople whose paychecks are based on commission, and one month they're getting nothing, and the next month they're getting a bonanza. In that case, it's really hard to say, well, what's my tax liability going to be? Therefore, what should my employer withhold? I don't know. It's hard to figure out. So the code has what are called these safe harbor rules, okay? And I wrote them up here. They're in your book. The safe harbor rules say that if your federal tax withholdings, okay, so your federal income taxes withheld by your employer, plus any estimated payments you make, okay, so these two, your withholdings, estimated payments you make, are greater than the lesser of one of these two numbers, then you should be, and I'm going to say should be, and we'll come back to why I'm saying should, not definitely, be okay, okay? So if your withholdings and your estimated payments that you make on your own are bigger than the smaller of these two numbers, you should be okay, okay? The general rule says if you pay at least 90% of your current year tax liability, you should be okay, okay? If you pay 100% of your prior year tax liability last year, okay, you should be okay. The rule changes there. It says if your AGI last year, your AGI, was more than $150,000, it becomes 110%. I don't make this up, I swear. Okay?
If your AGI is what?
If your AGI last year was greater than $150,000, I should just pay there. Or just make it legible. Then you have to use 110% of last year's liability instead of 100%. Okay?
Is that AGI for everyone, single, married, employer?
Yes, one number. Your AGI last year was more than 150, yes, based whatever filing status. There, they made it easy for you there. Okay guys, there's actually two other small sort of safe harbors. One says that, look, if last year's tax liability, you owed nothing last year, then you're not going to be subject to the under penalty this year. Okay? If you had zero tax liability on last year's return, you don't have to worry about underpayments this year. The other one says that if you look at your current year tax liability minus what your employer withheld, note, this does not include estimated payments you made. You only subtract off withholdings, okay? If your current year liability minus your withholdings are less than $1,000, don't worry about it. No underpayment penalty this year, okay? Those are two other small safe harbors. But I want to circle back to this bigger one, okay? So if your federal taxes withheld, your estimated payments are greater than the smaller of these two numbers, then you should be okay, guys? But the fact is you have to break it down by quarter to know, because you could potentially be over withheld in one quarter and under withheld in another quarter, and the year-end numbers aren't going to necessarily reflect that, okay? So you have to take it down and take it and break it down further, which is what we're going to do if you want to follow along for problem number 79. So we have Lloyd, he's a single taxpayer. He estimates his tax liability would be $10,000 this year. Last year his liability was $15,000, and he had $7,800 of federal income taxes withheld from this year's pay. And they want to know, is he required to increase his withholding or make estimated tax payments this year? Okay. So guys, you're going to follow your safe harbor rules. This is how I would do it. Okay. His current year tax liability is $10,000. Okay. To meet the safe harbor, multiply it by 90%. $9,000. Okay. You should be paid at least up to $9,000, hopefully, if he wants to be safe. Okay. The other option is 100% of last year. They told us last year was $15,000 times 100%. Guys, keep in mind, if the AGI was 150, that becomes 110%, right? But here it's not, so $15,000. Okay, guys, you only have to be paid up to the smaller of those two numbers. So here we're going to pick $9,000. His withholdings, guys, were only $7,800. So he is going to be under withheld, and he is going to want to have his employer adjust his withholdings, or he should be making some estimated tax payments, okay? Presuming the year is closed, it's too late for him to do anything, and he's out of luck. So, good? Okay, so what we want to do, guys, is we need to break this down by quarter now to see he is subject to a penalty, right? Because he didn't have withholdings plus estimated payments equal to at least the smaller of those two numbers. So we break it down by quarter, okay? His required withholdings, guys, are $9,000, the smaller of the two, okay? We're just going to take 25% of that small number, then make it 50%, then 75%, right up to 100%. Accumulate it each quarter, okay? You want to accumulate it. Withholdings, $7,800. The rule on withholdings says you spread them evenly throughout the year, okay? You just spread them evenly. So 25% here, 50% here, 75% here, 100% here, okay? Then we look at this quarter by quarter. So he is going to be under withheld in the first quarter by $300. He was required to withhold $2,250. His actual withholdings were only $1,950. So he's under withheld by $300. So I'm going to check myself. Okay. Then you have to multiply it by the penalty percentage. The rule says it's the federal short-term interest rate plus 3%. Federal short-term interest rate plus 3%. I think the book told us the federal short-term interest rate was 5. So don't just say 8%. Federal short-term interest rate plus 3%. Okay, you multiply them, guys, but then you divide by 4 because it's a quarterly penalty. Okay, you have to divide by 4 because it is a quarterly penalty. So for the first quarter, he was under withheld by $300. He has a $6 underpayment penalty. Okay? You can continue to work through the same things for the rest of the quarters. So in total, by the end of the year, guys, he would have had a $60 underpayment penalty if you add those all up. Okay? And again, you have to look at it by quarter.
They didn't know the homework do like something different than that?
They give you, see, I think sometimes they make it more complicated. They give you rates of like 22.5%, 45%. I would just say go through this exercise, pick the smaller number. Okay, if you pick the smaller number, then just 25, 50, 75, 100. Don't worry about memorizing 22, 25, 45, like that. It essentially would get you to the same place. But I think if you just pick the lesser of the two numbers and go this way, it's just one less thing to remember. I can go through with the actual cost. Okay, guys, what I want to point out, guys, is that let's just say he made an estimated payment. I'm throwing this in, it's not in the book. Let's just say he made an estimated payment of $1,000. He knew he was probably going to owe some money, and he wasn't really sure. But let's just say on July 11th, he mailed in a $1,000 estimated payment. Okay? That check would have been too late to apply it to the 6/15 cutoff. Okay, so it would have gotten applied with the 9/15 date. Okay? So that would have made him $68.50 there, and that would have made this $8,800. Okay, and we can go through and work through the numbers. But I want to point out, withholdings get applied evenly throughout the year, that's the rule. But estimated payments get specifically applied to the quarter that you paid them for, okay? So notice I'm not just taking my $1,000 estimated payment and spreading it $250 per quarter. Withholdings you do that with, estimated payments go specifically to the quarter. Here, because I keep doing math in my head, I'm not good at it. Guys, this would end up with him, right? He wouldn't no longer be under withheld, he would actually be over withheld by $100, so he wouldn't owe that, okay? He would still be a little bit under withheld here by $200, so you could figure it out. I'm just trying to show you here that estimated payments you apply specifically to a quarter based on when you make the payments, okay? Good, one more and we're done.
The 8,800, where did you get this from?
The estimated payment, right? I made an extra estimated payment of $1,000. So this is my actual payments column. Well, I had 78 withheld, plus I made a $1,000 estimated payment on my own. So I have to add it in. And I said I mailed it on July 11th. So I would have to apply it to the September payment date because it would be too late to meet the June 15th. Okay, so I would first add it there. But this is cumulative. This is building. So I would need to also add it on there as well.
Okay.
Okay? Okay, guys. Last part here. In addition to this underpayment penalty, which again is measuring what you're not paying during the year, okay, then there are the failure to file, failure to pay penalties. These potentially pick up on April 15th. Okay, so this one ends on January 15th, guys, the last day that you can pay by. Failure to file, failure to pay, pick up starting potentially on April 15th. Guys, going back to chapter 2, we talked about who needs to file a tax return, okay? We said you need to know filing status, age, gross income. I'm not gonna test you on it again. Okay, filing status determines your standard deduction. Age determines whether or not you are eligible for any additional deductions. Plus, you add in your personal exemptions. Okay, you compare that number to your gross income to determine whether or not you need to file. If your gross income figure is less than the sum of those numbers, right, you don't have to file a tax return. If your gross income number is bigger, you have to file. Okay, you have to file. Individual taxpayers, guys, have to file by the 15th day of the 4th month. For 99% of us, that's going to be April 15th, okay? If you can't file by that date, you can request an automatic 6-month extension. You have to request it, okay? And you can get until October 15th to file. Guys, an extension to file is not an extension of time to pay, okay? The clock starts ticking on the failure to pay automatically on April 15th. There is no extension of the time to pay. So, going back to filing, guys, the general rule says, look, it's a 5% penalty, okay, 5% penalty for each portion of a month that the tax is overdue. Two things in there. It's up to 5 months, okay, so it doesn't go more than 5 months, so it's maximum 25%. It is on not your tax liability, it is on the amount of tax you owe, okay? So your tax liability minus any withholdings, minus estimated payments you've already made, okay? It's on the amount you owe. The failure to pay, guys, starts on April 15th automatically, okay? This is a 0.5% penalty. And it's again up to 25% in total. So this one can run for a total of 50 months, 50. Can run for 50 months. It's also on the amount of tax owed. And there's a rule, guys, that says if both the failure to file and failure to pay are in effect at the same exact time, okay? The failure to file drops back to 4.5%. The failure to pay remains 0.5%. Okay, they could potentially overlap for 5 months. Potentially overlap for 5 months. Okay, and when that happens, in total there's a 5% tax. Failure to file pulls back to only 4.5 instead of 5. Now I want to point out, guys, if you file it, or I should say if you don't file a return, but maybe you paid taxes in full. So let's say you have a tax liability of $9,000. And let's say your employer withheld $95.05. And you're just like, forget it, it's not worth filing to get back $5. You don't have to file, okay? You don't have to file if you don't owe. You won't be subject to these penalties because the rule says that if you don't owe, you're not subject to the penalty, okay? It's the penalty is calculated on the amount you owe, not on the tax liability. But can you think of a drawback to not filing? Think back to the early days. The drawback to not filing. Statute of limitation, guys, okay? Statute of limitation. Your statute of limitation stays open forever. If you don't file, there is no statute of limitation, okay? They can come back and haunt you at any point in time. So it's always a good idea to file, okay? Let's pull it out. All right, one last example, and I'll let you guys get out of here.
If you decide not to file this in the current year, are you able to amend it in the following year on it?
You decided not to file.
Like the example here for the $5, say they just decide, could they decide later on, oh, I want to file for it, so I don't get hit with the statute of limitation.
Well, if you don't file, there is no statute of limitation. It just stays open.
Right, so are you able to file like the following year or no?
You can always file. Yes, you can always file. It's just that the statute of limitations will be delayed until you finally do decide to file. Okay, guys. So let's just say you have a tax liability of $15,000. Okay, you have withholdings of $11,400. This means you have taxes owed of $3,600. Okay. And let's say that it was due on 4/15, but you got around to filing paying on July 27th, okay? What I want to point out is this, okay? The tax says the penalty is for any portion of a month you are late, okay? If you don't pay by April 15th, you are late, okay? So any portion of a month starts the day after. So from April 16th through May 15th is 1 month, okay? From May 16th to June 15th is another month. From June 16th to July 15th is a 3rd month. And then from July 15th through July 27th is a 4th month, okay? Even if he filed, let's say, on July 16th, there would still be 1 whole month, okay? So this here will work out to be 4 months that he's late by. So his penalty, failure to file, they're both going to be in effect because he didn't file or pay. Okay, so what happens is the failure to file drops back to 4.5%. This is 0.5% times the $3,600 he owes times 4 months is $648, it should be. Okay, this one is 0.5% times the same 3,600 times the same 4 months. $72. Okay, $720 would be his combined penalties. Guys, if he filed on time, let's just say he filed on time here, okay, he just forgot to pay. He didn't write the check, or maybe he just didn't have the money, okay? Well, then the failure to file goes away. As long as he files on time, then he's okay. The failure to pay is still in effect, and it remains 0.5% times the $3,600 times the 4 months, and his penalty would be $72, okay? That assumes he filed on time, he didn't pay until July 27th, okay?
Is it 4 because, you paid in 27th of a portion of like another month?
Any portion of a month, so even if you're late by 1 day, so you have to file by April 15th, okay? If you file on April 16th, you're 1 whole month late, okay? So look at the months, and then any days that go past another month, it's a whole month. There's no, they don't prorate it. It's 1 whole month for any day you're late. Questions, guys? Sorry, I know I go through that quick, but we gotta get